This conference will now be recorded.
Hello, this is Jay Capel, JayOnTheMarkets.com. I also write a column for technical analysis of stocks and commodities called Explore Your Options. And this piece is going to be called a strategy you probably haven't considered. Whether you're a long-term stock investor, whether you're a short-term trader, if you trade options, whatever, you can use this strategy. First off, I have to tell you that trading involves risk, and that nothing that I tell you should be construed as investment advice or recommendations. I am going to show you an example trade today, but it's really nothing more than that, just an example. Okay, here's where we are. The way things are right now, there's a number of industries that are in big trouble. Airlines, cruise lines, hotel and gaming, car rental, travel-related services, and many others. Because of the pandemic, they're simply struggling because there's nobody using their services. So what's interesting right now is either a great time to be buying these stocks because everybody hates them and they're way down, or it's a terrible time to be buying these stocks because they have no business and nobody really knows what's going to happen, right? And that's the key point. Nobody knows for sure what's going to happen to these industries. And I am not going to tell you that you should go out and buy stocks of airlines or car rental or any of that, because I don't know what's going to happen with them. However, there is a phrase that I found a long time ago that I like, and that is opportunity is where you find it. So that's where we're going to look today at something called a cash secured put. Okay. So let's just get right into an example rather than a long-winded discussion of what it is, because I think the example will explain it pretty well. The questions you need to answer, we're going to focus on American Airlines, ticker AAL. Do you think American Airlines will survive? That's the key question. If you think there's a chance that they may go bankrupt, then this strategy is probably not one that you're going to want to pursue. But if you think they will survive and maybe thrive somewhere down the road, well, then let's continue. The other question is, are you willing to risk any money on that opinion? And again, what you're going to find out is we're not talking about buying the shares and holding on to them and maybe hoping someday they turn around. Okay, first I have to explain something. Implied volatility of options. I'm going to make it as simple as possible. Low IV means options are cheap. And what that means is each option has something called time premium built into the price. I'll show you this in a second. If implied volatility is low, that means there's very little time premium. And if implied volatility is high, it means there's very high time premium. So let's take a quick look at an example, if I can get to it here. Okay, stock is trading at $50 a share. The option strike price is 50. The implied volatility, let's say, is 10 with 247 days left till expiration. The price of that call option, in theory, should be about $1.56, okay? Now, what if implied volatility was at 20? Well, then the theoretical value of that option goes to $3.18. And what if some strange case implied volatility shot up to 100? At that point, this option is going to be trading for over $15 a contract. Okay, why is this relevant? Okay, this chart is ticker AAL. You see the price movements here. Now this is through December 31st of this year, and I did it this way for a reason, which you'll see. And what you see is the black line is the implied volatility for options, all the options 90 days or more until expiration. And you can see this goes up and down. And so it's just what I said before. When it's down low, it means options are cheap. There's not a lot of time premium. And when it goes up, then they get more expensive. Now, let's fast forward to current time. All right, so everything that I just showed you, this black squiggly line that goes way up and way down between about 30 and 50 if we look at it here, all of a sudden it's very compressed. Why? Because when all the trouble started and the stock fell apart, what happened? Implied volatility went to the moon. Why is this? Fear. People bidding up options basically to cover themselves. And what does this mean? It means the options are very expensive. And then, of course, I'm going to zoom in just a little bit more. So we see what happened. The pandemic hit, stock got crushed, the volatility went way up. It came down a little, quite a bit when the stock market or when the stock stabilized, but now stock is working its way lower again, could even be breaking down to new lows, and implied volatility is still very high. Okay, so let's take a look at a cash secured put. Here's what we're going to look at. January of 21, so we're talking about 8 months from now, 247 calendar days. Stock is trading at $9.11 a share. We can sell the January 3 put for 103. Okay. Now I'm actually going to change it just to make the numbers easier. I'm going to change it to $1. $1. Okay. And let me find okay. And I am going to just bear with me one second. Going to zoom out just a little bit. Okay, so here's what we did. The stock, like I showed you, is trading at $9.11 a share. That's this blue line. What's it going to do from here? Is it going to fall apart? Is it going to rally? I don't have any idea. It's not really relevant at the moment. So we sold this option January 15, the 3 strike price put for $1. What that means is somebody pays us $100. What does that also mean? It means if it gets down to $3 a share, we have to buy 100 shares of stock. So let's go back to our numbers here. Stock price is at $9.11 a share. Strike price is 3. We have to have $300 cash in our account to do a cash secured put. Why? Well, if the stock comes down to $3 a share, we have to buy 100 shares. How much does it cost to buy 100 shares at $3 a share? $300. However, we took in $100 when we sold the option. So what that means is we only need to put up $200 of our own cash. Hopefully you're with me on that. So we took in 100. Our maximum risk is 200. Okay, so that's kind of interesting. It means if this option expires worthless, we make 50%. Now let me come back to that comment. Okay, first off, let's note the stock has to fall 67% in the next 8 months before we even really have to worry about it, right? From 9 down to 3 is another 67%. Can that happen? Absolutely, of course. It's already lost at least that much from its peak. And if the stock is going to fall apart and the company's going to go bankrupt, it's going to go down 100%. So yes, that can happen, but still gives us a pretty good cushion. Okay, what can happen once we get into this trade? We sell short a put option, we take in 100, we put up 200 of our own cash. Worst case scenario, let's start right there. American Airlines goes bankrupt. What's going to happen? We're going to lose everything we put up. Okay, so we have the risk of 100% loss. However, we also have control of how much money we actually want to risk. In other words, if we do a 1 lot, we're risking $200. If we do a 10 lot, we're risking $2,000, and so on. And so you can see it right here on this chart. This is a risk curve. This black line is what this position will look like from a profit or loss basis at expiration. If the stock price goes to 0, we lose $200. That's our worst case scenario. So if you think American Airlines is going to go bankrupt, you don't want to be anywhere close to this. Okay. Scenario number 2, the stock comes down to under 3, the option is exercised, we have to buy 100 shares. but American Airlines remains in business. Well, so what happens is we buy 100 shares at an effective cost of $2 a share, right? Because we're paying 3, but we took in 1. So we're paying $2 a share for 100 shares of American. And then we can hold on to those shares as long or as short of a time as we want. So the best case scenario here, it comes down, we buy the shares at a effective price of $2 a share. And then over the years, it works its way back up to 20 or 30 or $50 a share. Turns out to be a pretty good opportunity in that scenario. Scenario number 3, American Airlines stays above $3 a share through next January. In other words, it never comes down and causes us to buy the shares. In that case, we keep the $100 premium, which is a 50% return on our cash at risk. Remember, we go back here. So this black line, if the stock comes down to $4 a share, or even $3.01 a share, we still keep the entire $100 that we took in while risking 200. So that's a 50% return. And then the other possibility, if it stays above $3 a share and implied volatility comes down. Okay, well, what's that going to do? Well, let's take a look. Okay, let me just update this 1 second. I'll put, okay, so here's where we are now. Stock is trading at $9.11 a share. Strike price is 3. The option's trading at 103 for the January. So it's telling us that the implied volatility on this option is 199. Now remember, in that first screen I showed you, historically it's between 30 and 50. For this option, it's almost 200. Okay, what would happen if, say, 3 months from now, something good happened? The skies parted, fear kind of abated a little bit. Now, let's say implied volatility came down to 100, which is still on the high end of the historical range. But so we're going to go 90 days in the future. So what's going to happen to the theoretical price? Right now, it's 103. If 3 months from now, let's say the stock is unchanged, the implied volatility drops from 199 to 200, the value of that option is going to be 6 cents. Okay. Now, even if the stock comes down to 450, the stock loses 50% of its value. It's going to be worth 38 cents per option. So what happens then? Well, we keep some portion of that up. So let's say 90 days from now, American drops from $9 to $4.50 a share, but along the way, implied volatility drops from 199 to 200. Okay, as I just showed you, that option would be worth theoretically about 38 cents. We sold it at $1. We could buy it back at 38 cents, make $62, which is a 31% return in 3 months on our $200 risk. Okay, so that is an example of a cash secured put in a really interesting situation. Again, there's a lot of risk. Make no mistake. These stocks can get hit very hard, and on a case-by-case basis, some of them may go bankrupt. But if you do your homework and you find a stock that you think is going to make it in the long run, then a cash secured put gives you an opportunity to either A, take in a very good amount of income on a small dollar risk, or B, buy shares at a dirt cheap price and maybe hope someday they come back. And so that is it. So thank you for listening. This is Jay Capel signing off. Take care.